Hello, hello, hello. Welcome. For those of you who are watching me for the very first time, my name is James Ambroise, and on this channel we cover how to pay off debt faster than any other debt repayment method out there. We cover basic bookkeeping and accounting for someone who just started out a small business. We cover basic personal income tax to include a Schedule C, Schedule E, depreciation. I am also the author, creator of Ambroise Method 1.0 and Ambroise Method 2.0. Ambroise Method is a revolutionary debt repayment method that offers greater results in terms of reducing interest cost compared to debt snowball, debt avalanche, velocity banking. Real quick about my credentials, I have been or am a bookkeeper and accountant, QuickBooks Pro advisor, senior tax advisor, residential real estate investor, residential property manager, financial coach. And as always, before we get started with what's on the board, please allow me to shout out the name Jesus, my Lord, my God, my Creator. Thank you. All right, America, on the board we have this hypothetical scenario of somebody who filled out one of my Microsoft Excel worksheets, and the person provided me with these figures. For that, this person has a credit card and a HELOC. Original loan amount, the credit limit, $10,600. The APR, 29.99%. Balance owed, $10,000. Monthly payments charged, I put a question mark because we're gonna try to figure out what the monthly payments charge gonna be for the cycle for the credit card. And the previous day balance on the credit card was $10,000. On the HELOC, the original loan amount $10,300, APR 8.25%, balance owed $10,000. So we're keeping the balance the same, okay? Because later on we want to do an apples to apples comparison. So $10,000 for the credit card, $10,000 for the HELOC, okay? Monthly payments charge, again, I have a question mark because we're going to try to figure out what the monthly payments charge is going to be for the cycle on the HELOC. Okay, this HELOC, this particular HELOC is interest only, so they're only charging interest. And the previous day balance was also $10,000. Okay. For income, we have $9,000 on day one because we're gonna try to mimic what one of our competitors is doing. The expenses that could go on a credit card, including whatever old monthly payments charge, was $7,000. Okay. All right, America, we're doing a scenario for a financial coach. And the question posed to me was, James, on your last lesson, on your last case study, you mentioned that a credit card is a higher performer than a HELOC. Okay? In other words, a credit card is a better debt weapon than a HELOC. So can you prove to us, James, that a credit card is truly a better debt weapon than a HELOC? Okay? All right, America, today we're doing case study number 17. And today's date is June 13, 2025. Okay? That is the day that I'm doing the video. All right, America. I'll give you about 5-10 seconds to take a look at what's on the board, and then we're going to start with the exercise. All right, America. And again, question posed to me from financial coach was, James, On your last lesson, you mentioned that a credit card is a better debt weapon or a better debt tool than an HELOC. So can you prove to us that a credit card is truly a better debt tool than an HELOC? All right, America, I'll try my best. America, lately on my examples, when I'm using an HELOC, the balance is typically 10,000 bucks. The reason why I keep using 10,000 is because someone from Velocity Banking, a financial coach from Velocity Banking, mentioned that when you're trying to chunk or when you're trying to send a chunk payment, okay, a bigger chunk payment will not work, but a smaller chunk payment like a 10,000 chunk payment will work. So that's why lately I've been using $10,000 on my examples, okay? Just to prove to those guys that a smaller chunk payment will not work. Because, you know, these folks, they are misinformed. So, for example, if you could get an HELOC as a first lien position, in some instances, they're saying do not get the HELOC as a first lien position, get the HELOC as a second lien position. Okay. Or, if you're still going to get the HELOC as a second lien position, make sure that, you know, the chunk payment is a low amount. Okay? So, and one of the example they were using, that's why they were saying. Okay? So, and we're gonna prove to these guys that $10,000 will not work. Okay? Just like if it was a $20,000, it would not work. Okay? All right, America. On the board, I have the average daily balance calculator. Okay? Just like we've done from last lesson, for cycle, we have day 1, day 2, day 3, 4, 5, all the way to day 30, because my competitor, Velocity Banking Group, likes to always use 30 days. So that's why we stop at 30. And again, folks, remember, a cycle doesn't always have 30 days. Some cycle have 28 days, 29 days, 30 days, 31 days. Okay? For beginning balance, we have 10,000. And again, the previous day balance on the HELOC was 10,000. So before day 1, it was 10,000. So 10,000 gets rolled over to day 1. So that's why it's 10,000 here. And again, the previous day balance was 10,000. So the balance before day 1. Okay. For purchases or advances, that column is blank for now. For payment or credit, that column is blank for now. The reason why, remember, most of the lenders, most of the creditors, they use an average daily balance, including new transactions. Again, these are the columns for the new transactions. Purchases or advances, okay? Payments or credit. These are the new transactions, okay? With compounding, okay? And this is the ending balance, okay? And later on, we're gonna try to figure out the total, okay? And same thing over here for the credit card, because we're going to be comparing the credit card with the HELOC. Okay? For cycle, same thing. Day 1 all the way to day 30. Same thing. Okay? Beginning balance, 10,000. Okay? Same thing. Purchases or advances, payments or credit. Purchases or advances, payments or credit. Ending balance, ending balance. So we have the same exact items that we have, okay, for the HELOC. We have the same items for the credit card, because we're gonna be comparing these two, okay, for an apples to apples comparison, okay. And down below, I have the original rate, the effective rate, the difference in percentage savings, the original monthly interest charge, new monthly interest charge, difference in monthly interest cost savings, okay. All right. Now, my competitor, Velocity Banking Group, okay, these folks, they are misinformed. They think that having movement of income and movement of expenses inside an HELOC usually yield the greatest results in terms of reducing interest cost. Okay. On this lesson, on this case study, we're going to prove to them that that's not the case. All right. Compared to a credit card, because again, we want to prove that the credit card is a higher performer than a HELOC. In other words, the credit card is a better debt tool than a HELOC. Okay. Now, let's see what the monthly payments charge would be if we did not do anything. Okay. And again, this section is for the HELOC, and this section is going to be for the credit card. Okay. So on the HELOC, if we did not do anything, okay, what the monthly payments charge would be. All right. So if we don't do anything, America, so $10,000. So for the whole cycle, we didn't have any new transactions at all. Okay. So 10,000 plus 0 is 10,000. 10,000 minus 0 is 10,000. Okay. And again, we did not have any purchases or advances. We did not have any payments or credit. Okay. So 10,000 ending balance on day one. That figure gets rolled over to day two. So that's why it's 10,000. And again, we did not have any transactions. So 10,000, 10,000. 10,000 for day three, 10,000 for ending balance. 10,000 on day three becomes $10,000 in day four, plus 0 minus 0 is still 10,000. Okay, and again, we did not have any new transactions, so the figure is gonna stay the same. Okay, for a lender who is using an average daily balance, including new transactions without compounding. Okay, if he was compounding, that would have changed a little bit because we would have to add the interest. Okay, but this one is without compounding. Now, even though most of the lenders use an average daily balance with compounding, the reason why, just like I mentioned to you guys from the last lesson, I do not want to put my formula on the board for with compounding. So the formula that includes with compounding, so I'm putting the one without compounding. The reason why, just like I mentioned from past lessons, we do not want our competitor to copy our formula. So that's why we're using without compounding on the board. And again, without compounding is readily available online, but the formula for with compounding is not readily available online. Okay, so I have my own proprietary Excel formula for average daily balance, including new transaction with compounding, but I do not want to put it on the board because I don't want my competitor to copy what we are doing. Okay. All right. So 10,000, 10,000 all the way through, 10,000, 10,000, 10,000. Okay. The way they arrive at the monthly interest cost for the cycle, they add all the ending balances. Okay. Let me go ahead and grab my calculator. Okay. Since we did not have any movement, that $10,000 stayed constant from day one all the way to day 30. Okay. So 10,000 from day one, day two, day three, day four, day five. So we have that all the way through day 30. So 10,000 times 30. Because we have 30 days in a cycle. So we are at 300,000. Okay. All right, folks. 300,000. And again, we add all the ending balance for the cycle divided by the number of days in a cycle. So 300,000 divided by 30 days in a cycle. Okay, so now we're back to 10,000. Okay. And again, if you have the same figure all the way through for whatever how many days, okay? Divided by the same number of days, you're gonna arrive at the same figure, which is 10,000, okay? That 10,000 is the average daily balance. For a lender who is using an average daily balance, including new transaction without compounding, okay? Now, the way to arrive at the monthly interest cost for the cycle is gonna be the interest rate, the APR, converted to a daily. So the APR on the HELOC is 8.25%. So 8.25%, 8.25 divided by 100, divided by 365, is this lender is using 365 days. Okay. Again, some lenders could use 360, 365, 366 on a leap year. Okay. And we're in 2025. 2025 is not a leap year, so they're gonna be using either 360 or 365 days. Okay. But this particular lender gonna use 365 days. So we are at 0.0002260,274. Okay. Again, 8.25% converted to a daily. Okay. Times the average daily balance times the number of days in that cycle. And that cycle is 30 days. Okay. So 8.25 times 10,000 bucks times 30 days. Okay. Now, the monthly payments charge or the monthly interest charge for the cycle would be $67, $67.81. So we are at 67.81 for original monthly interest charge if we did not do anything. Okay, 67.81. All right. Now, let's do the same thing over here. Same thing. Cycle from 1 through 30. And again, we had no movement. Okay. So this $10,000 is going to stay the same all the way through 30 days. Okay. So 10,000 times 30, which is the number of days. And we add all the ending balances. So we are again at 300,000. Divided by the number of days in the cycle for the credit card. The number of days, 30 days, because we're trying to have an apples to apples comparison. So now we are back at 10,000 bucks. Okay, for average daily balance. Okay, America. So same thing. We're gonna try to figure out on the credit card what the monthly interest charge or the monthly payments charge should be if we did not do anything, no movements, okay, no new transactions. Okay. So again, we're gonna convert the APR to a daily rate. So this time it's 29.99%. Okay. So 29.99 divided by 100 divided by 365. So we are at 0.0008216 Okay, so it is the APR converted to a daily, 29.99% converted to a daily, times the average daily balance times the number of days in the cycle. We had 30 days. Okay. So that figure times 10,000 times 30 days. Okay. Now, the monthly interest charge, if we did not do anything, that one would have been $246.49. Okay. All right, folks. Now, and again, my competitor wants to dump all of the income onto the HELOC. Okay. So this time we're gonna run a different scenario to see what the monthly payment charge would be when you dump all of the income onto the HELOC. And what they like to say, they're gonna use the HELOC as a new check, as their new checking account, and they're gonna pay bills from the HELOC. Okay. We put from last case study, that is not really a new checking account because at some point you have to move the money back to your regular checking account. Okay. So that account did not replace your regular checking account because at some point you have to move the money back in your regular checking account. Okay. So this thing about that checking account replaces the old account now. Okay. You're still gonna use your regular checking account. Okay. Now it is true some HELOC comes with debit cards and some checks. Okay. But for what you're trying to accomplish, you don't want to write a check to a creditor, to pay your bills, to pay your expenses. Because if you write a check, so you have to mail the check. Now you have no control as to when the check might arrive to the destination place. Okay. So for those of you who are kind of confused, say, oh, well, a HELOC also comes with checks. Can't use your checks. Okay. Unless you're going to go to the place directly and just give them the check. Okay. Well, if you have like 20 to 40 different bills and expenses, what are you going to do? You're going to stop at every single location? Well, there comes a check. There comes a check. No. Okay. That would not be the right way to do it. So that is why they are forced to move the money back to the checking account. From that checking account, okay, you could just sit at home and do transactions. Okay, you could just call them up on the phone, okay, to pay these transactions. Okay, because there are restrictions in those checks that you receive from the HELOC. There are certain bills you cannot pay with those checks. Okay. And the ones that you could, okay, you'll be forced to physically take them there because if you try to mail them, and again, you have no control as to when they might get to the destination place. If you're gonna mail the checks, it's gonna take at least a few days. Well, that will kind of defeat what you're trying to accomplish. Okay? Because if it's gonna take a few days, in the case of you mailing the check, it just simply would not work. Okay. I said the postal service did not deliver the payment on time. All of a sudden now you're gonna be late. Okay, so you cannot use those checks a lot of times. Okay, for what you're trying to accomplish. Okay, it's much easier, way more convenient to just move the money back to the checking account and allow the checking account, your regular checking account, to do its thing. Okay. All right. Now, we're gonna dump again all of the income onto the HELOC. And these folks, they always wanna inflate their numbers. So for that reason, we're gonna show that all of the income touched down the HELOC on day one. Okay. First of all, most of them don't even use that kind of formula because the folks, my competitor over at Velocity Banking Group, they do not know how to compute the interest cost properly. That is why they always use an average. Okay, you add this number by that number, and for however how many numbers, you divide it by 2 or you divide it by 3 to get an average, and that's how they're trying to figure out the monthly payments charge. Nah, that is not the proper way to figure out your monthly interest cost for the cycle. You don't use an average to figure out your monthly interest cost for the cycle when the lender is already telling you that they don't use average. Okay, not that type of average that they're talking about. Okay, so, and again, we're going to run a scenario where we dump all of the income onto the HELOC on day one. And all of the income represents a payment because it's going to reduce the balance on the HELOC. Okay, so 9,000 going to be minus 9,000 here. Okay, so if on day one you dump all of the income, like my competitor likes to do, so 10,000 minus 9,000, so the ending balance is going to change. Okay, so, and on day 26, they're going to make an advance from the HELOC back to their regular checking account. So we're going to erase everything here because this figure is going to change. All the way to day 26. Again, the first scenario, that's when we're not having any movements. This time, we're dumping all of the income onto that account. Okay, so 10,000 minus all of the income on day one. So we are at 1,000. Okay, 10,000 minus 9,000, we're at 1,000. Okay, 1,000 gets rolled over from day one to day two. Okay, so now this is gonna change as well. Okay, so 10,000 on day one. Minus 9,000, 1,000. So we have 1,000 here, and we did not have any new transactions. So we're gonna have 1,000 here, 1,000 here. 1,000. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26. Okay, let me make sure I got enough for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 10, 11. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26. Let me do this. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, bear with me, America, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26. Okay. All right. Now. Okay. And over here, same thing. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25. Okay, so let's stop right here. Now, on day 26, financial coach gonna move $7,000 from the HELOC back to the checking account. Okay. All right. So now, $1,000 plus 7,000, we are at 8,000. Okay? 8,000 from day 26 get rolled over to day 27. So 8,000 here, 8,000 there. 27, 27, 28, 28, 29, 29, 30, 30. Okay, folks? 1,000 all the way through day 25. Okay? And on day 26, financial coach made the advance for $7,000. Okay? Now, let's figure out what is the total for the ending balance. Okay? So how many 1,000 we have? Okay, 1,000 stay constant all the way to day 25. It changes on day 26. Okay, so we're gonna have $1,000 times 20. Let me put that a little higher. $1,000 times 25 5 days. Okay. Here's 25,000. Okay. Then on day 26, you went from 1,000 to 8,000. So how many 8,000 do we have? 26, 27, 28, 29, 30. So we have 1, 2, 3, 4, 5. 5 times 8,000. 5 times 8 is 40. So this should be 40,000. All right, when we add them up, 25 25,000 plus 40,000 looks like we're at 65. Okay. Okay, folks. That is the total when we add all the ending balances. Okay. You went from 300,000 to 65. So we're going to take that figure divided by the number of days in the cycle. Number of days is 30 days. So 65 divided by 30. Okay. So now for average daily balance, we have $2,166.67. Okay, folks. Same thing. The APR converted to a daily for the HELOC 8.25 divided by 100 divided by 365. Since this lender is using 365 days, so we are at 0. Put it right here. 0.0002260,274. Okay, times the average daily balance times the number of days in a cycle. Okay. So that figure, 8.25 divided by 100 divided by 365 times the average daily, $2,166.67 times the number of days in a cycle times 30 days. Okay. So now, for having movements of income and movement of expenses, well, let me use their terminology. For having income coming in and expenses going out. Okay. Now, the new monthly payments charge or monthly interest charge going to be $14.69. So new monthly interest charge, $14.69. Okay. Now, the difference in monthly interest cost savings. Okay, if financial coach did not do anything, it would have cost them $67.81 for monthly payments charge or monthly interest charge. But since they had this movement of well, let me use the terminology, since they dump all the paycheck into the account, okay, and run all their expenses through that account by moving the funds from the HELOC back to the checking account. Okay. Now, the new monthly interest charge, you went from $67.81 to $14.69, a difference of 6781 minus 1469. We are at 5312. 5312. This is how much they are savings. Not bad, not bad at all. Okay? For having movement in that account, saving $53.12. Okay? Now, the original rate on that account was 8.25%. Okay? So, if now we are at 14.69, what does that represent? 14.69. This is where we are. This represents 1.76%. That's the effective rate. Okay. All right, folks. So you would have cost them 8.25%. Now you only costed them 1.76. Okay. A savings of 8.25 minus 1.76. A savings of 6.49. So they saved 6.49. You would have cost them 8.25, but you only cost them 1.76, so a savings of 6.49, which is the difference between this figure and that figure. Okay? It would have cost them 68.81 if they didn't have any movement. For having this movement of income, for dumping all that their paycheck into that account, it only cost them 14.69. Okay? So they save 53.12. Okay? All right, America? Now, let's run the scenario that if we were to have these movements of income and movements of expenses inside the credit card instead. Let's see how we'll do. Okay? So, same thing, 10,000. Remember, these folks are going to show all the income going to come in all at once. So 10,000 minus 9,000. Okay, because when you dump all the paycheck into that account, it represents a payment. So it's going to bring down the balance. The balance is going to go from 10,000 to just 1,000 here. So we're going to have to erase some stuff as well on that side. Okay, so 10,000 minus 9,000, we are at 1,000. Let me just put 1K over here. All the way through. 2, 3, 4, 5, 6, 7, 8, 9, 10, bear with me, America. 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25. Okay? And same thing here. 10,000 minus 9,000 is 1,000. 1,000 gets rolled over from day one. Ending balance on day one becomes the beginning balance on day two. So these, we have to change these as well. Okay? 2, 3, 4, 5. Bear with me, America. 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, and on day 26, financial coach wants to move 7 grand. This time he's not going to move 7 grand. The funds are already inside the credit card. Okay? Remember, all these bills, all these expenses could go on a credit card, including the interest charge on the credit card itself. $7,000 because we're trying to have an apples to apples comparison. So plus 7,000. Okay. So 1,000 plus 7,000 on day 26, we're all at 8,000. Okay. 8,000 becomes the beginning balance on day 27. 8,000 here, 8,000 there, because we didn't have any new transactions. 8,000 day 27, 8,000 day 28, 8,000 day 28, 8,000 day 29, 8,000 ending balance on day 29, 8,000 on day 30, 8,000 on day 30. Okay. The old one was 300,000. What's the new one's going to be? So how many 1,000 do we have? We have 1,000 for 25 days. On day 26, the ending balance changes from 1,000 to 8,000. So we have 25 times 1,000. And then we have how many 8,000? 1, 2, 3, 4, 5. So we got 5 times 8,000. Okay? Remember, we have 30 of them. 25 plus 5 is 30. Okay? So 25 times 1,000. So 2, 5. 1, 2, 3 zeros. 5 times 8 is 40. So 40, 1, 2, 3 zeros. 25 plus 40, we are at 65. Okay? That would be the ending balance. 65,000. So you went from 300,000 to 65. The lower, the better. Okay? So 65,000, when you add all the ending balances, we had 65,000 divided by the number of days in the cycle. Number of days is 30 days. So 65 divided by 30. So we are at 2,16667. Okay? So we are at $2,166.67. for average daily balance. Okay? And again, we're gonna do the interest, the APR converted to a daily. This time it's 29.99%. 29.99% divided by 100. 29.99 divided by 100 divided by 365. Okay? We are at 0.00082164438. That is the APR converted to a daily times the average daily balance. We've determined that the average daily balance is 216667, $2,166.67, which is 65,000 divided by the number of days times the number of days in a cycle, 30 days. So that times 216667, that times that one, times 30 days. Okay, so for monthly interest charge, monthly payments charge, or monthly interest charge for the cycle, we are at 5341. 5341, which is that figure times this figure times 30 days. Okay? Now, let's see what the effective rate is if we arrive at $53.41. We are at 6.41%. Okay? All right. The original rate, America, was on the credit card was $29.99. Okay? So they would have charged us $29.99, but now they're only charging us $6.41 because that's what $53.41 represents. So instead of getting charged $29.99, we're only getting charged $6.41. So the difference is our savings. So $29.99 minus 6.41. So we have a savings of 23.58. The original monthly interest charge, if we did not do any movement, it would have cost us $246.49. Now it only cost us $53.41. The difference is our savings, $246.49 minus 53.41, a savings of $193.08. You see that, America? Now, earlier, financial coach posed a question to me saying, hey, James, on your last lesson, you mentioned that a credit card is a higher performer than an HELOC. In other words, a credit card is a better debt weapon than an HELOC. So you wanted me to prove in this hypothetical scenario that a credit card is truly a better debt weapon than an HELOC. All right, well, let's take a look at our results. And again, the original rate on the HELOC was 8.25%. 8.25%. The effective rate is now 1.76, because if you do 10,000 times 1.76, 10,000 times 1.76% divided by 12, we are at $14.69. Okay, so a savings of $6.49. It would have cost us 8.25. You only cost them 1.76, so a saving of 6.49. Same thing on the original monthly interest charge. If they did not do anything, it would have cost them $67.81. For dumping all of the income into the account and have that account pay the expenses, it only cost them $14.69, a savings of $53.12. Okay. Over here, the original rate $29.99. The effective rate 6.41, and again 10,000 bucks times 6.41% divided by 12. We are at 53.41. So 53.41 represents 6.41% as far as effective rate. Okay. So you would have cost them $29.99. Now you only cost 6.41%, so a savings of $23.58. So $29.99 minus 6.41. Okay, we saved 23.58%. The original monthly interest charge, if we did not do anything, would have been $246.49. Okay, for having this movement of income and movement of expenses. Let me use the terminology for dumping all the paycheck into the account and have the account pay your expenses. We are at 3.41. Okay. It would have cost this much. Now it only costs this. So the difference is our saving, $193.08. Okay. Now, let's pay attention to the difference in percentage savings. Over here, if you dump all your income onto the HELOC, you save 6.49. Over here, for having an apples to apples comparison, if we dump the same amount of income, 9,000, 9,000. 7,000 goes out, 7,000 goes out. Okay. The difference in percentage saving is 23.58. I'm working out which one is bigger. I could save 6.49 or I could save 23.58. So we're saving more for having our movements of income and movements of expenses inside the higher APR line. The higher APR line is the credit card, 29.99%, because 29.99% is higher or bigger than 8.25. Well, let's go down in the difference in monthly interest cost savings. For them, they're going to save $53.12. For us, we're going to save not just $53.12, we're going to save $193.08. Which saving is bigger, America? 53.12 here, 193.08. $193.08 is bigger or better or greater than $53.12. So the folks over at Velocity Banking Group, because these people, they don't quite know what they're doing, they don't fully know how to properly use a so-called debt weapon or debt tool. So they've been running their numbers on the wrong account, on the wrong debt weapon, on the wrong debt tool, on the wrong line, on the wrong credit line, on the wrong debt destroyer. You cannot call it a debt destroyer when it forces you to go backwards. And again, they're going backwards. Smaller savings. Then this. Smaller savings. Then this. Okay? These little rookies over at Debt Velocity Banking Group, they're trying to challenge me on YouTube. These people, they have no clue what they're doing. They couldn't even properly pick the right debt weapon. Dealing with somebody who mastered this thing called paying off debt. Bunch of rookies trying to harass me on YouTube, sending me message all the time, thinking that they have something great when they dump all their income into an HELOC. America, they find themselves a little shiny object called HELOC, but because these folks, they don't quite know how to run numbers, okay? They don't know what to do. Oh, it's a HELOC. Okay, I could dump all my income into it and I could pay all my expenses through it, okay? So that one aspects of it got them confused, because remember, for HELOC, you could pay all your income and you could sort of pay all your expenses through an HELOC, even though you're gonna need help, okay, by employing your regular checking account again, okay? But that's besides the point, okay? But on a credit card, a lot of times, not every bills, not every expenses can be paid with a credit card, okay? So they think because all bills could be paid through an HELOC, and on a credit card, not every bills could be paid with a credit card, they take the HELOC is the better debt weapon than a credit card. These folks, they are misinformed. Okay, let's assume that's the case, where not all bills, not all expenses can be paid with a credit card. All right. This scenario here proves to you that head-to-head, the credit card wins. So if head-to-head, if the numbers are equal, the credit card wins. We're in a situation where the credit card cannot cover everything. Well, we already know if everything is the same, the credit card wins. If everything is the same. But since the credit card a lot of times cannot cover everything, but you already know if everything is the same, the credit card wins. So in this case, you have to employ a new technique, a technique that I refer to as, that I called Ambroise's partitioning a balance. In this case, it's gonna be Ambroise's partitioning an expense. Let me put down on the board. So Ambroise's partitioning an expense. In the past, we've done Ambroise's partitioning a balance. This time, it's gonna be Ambroise's partitioning expense. These rookies harassing me on YouTube, they have no clue what they're talking about, man. So, let's assume the expense were $7,700 because the credit card could not cover everything. So the total expense was 7,700. Not 7,000, but you was more. Let's assume you was more. Okay? And 7,000, including the interest cost that the lender, the creditor, earns on you, could go on a credit card. Okay? So in that case, then, since we already know that head-to-head, the credit card wins, so we'll partition that expense. So it'll be 7,000 Since we're going to partition that expense, we're going to break it down into at least two separate parts. Sometimes we'll partition it at least three separate parts, but at least two separate parts, where one of the part will equal the amount that could go on a credit card. So it will be 7,000 plus 700. That's how we arrive at 7,700. And again, we're partitioning that expense into two parts. One, two, at least two parts. In this example, I just want to do two real quick. 1, 2. Okay? And again, going back to the example, head to head, the credit card wins. So in that case, you send that portion to the credit card. Only the remainder that could not, because the credit card a lot of times cannot cover everything. So only the remainder that the credit card could not cover, that remainder needs to go this time to the HELOC. But because these folks, they don't know how to properly analyze this thing. Oh, since this account cannot cover, since the account, the credit card cannot cover everything, okay, in some example, okay, so they completely abandon the credit card for the HELOC because the HELOC could cover everything. And again, you could pay all your bills in a way through a HELOC, but you cannot pay all your bills through a credit card, okay? But you know that head to head, the credit card wins. So you have to send the portion that the credit card could handle to the credit card. Only the portion that the credit card could not handle will go to the HELOC. These folks over at Velocity Banking Group, they are not thinking outside the box, okay? Because they have a narrow view of this debt, of this paying off debt thing, okay? The second, they know that every bills, every expenses could go on a credit card, on an HELOC, they quickly pick the HELOC. No, because head to head, if everything is equal, 9 here, 9 there. 7 here, 7 there. Once everything is equal, if everything is equal, when we have an apples to apples comparison, the credit card wins. And again, the number don't lie. 6.49 here is a smaller savings than 23.58. 6.49% is a smaller savings than 23.58%. $53.12 is a smaller savings than $193.08. Okay? These folks, so far, they haven't proven to have the capacity to properly analyze things. That's why they couldn't figure out that part out. Okay? In a case like this, they'll try to dump the entire 7,700 onto the HELOC. But head to head, the credit card wins. So if head to head, the credit card wins, why are you abandoning the credit card? Don't abandon the credit card, says the portion that the credit card could handle to the credit card. America, that is how you achieve greater results in terms of reducing interest cost. And the numbers don't lie. Bunch of rookies over at Velocity Banking Group trying to challenge us over at Ambroise Method. Don't you ever do anything like that. Because you guys are too small when it comes to properly analyzing numbers. You guys not quite there yet. Most of you guys, your background's kind of questionable. These folks, they find little shiny objects called HELOC, and they're like little kids in love. Let me dump all of my income into an HELOC. Why? Because the HELOC offer greater liquidity. Because all bills or expenses could run through the HELOC. Bunch of rookies, man. They're not properly analyzing things. Head to head, the credit card wins. Because when you have the options, America, to have movements of income and movement of expenses inside two credit lines, you need to pick the higher credit line. And the credit card had the higher APR, 29.99%. That's how you break it down. That is why in our method, a lot of times we use two separate alternative accounts. We use the credit card for bills that could go on a credit card, and since the credit card could not cover everything, in an example like this, if we had any extra expense that could not go on a credit card, we'll send it to the HELOC instead. So it would be a combination of both. Credit card first, then the HELOC second. Well, the credit card priority and the HELOC, after the credit card. Bunch of rookies, man, trying to challenge me. These people, they don't know. Anyway, let me try to be nice. America, even the folks over at that snowball group will tell you that whenever you have two debts that have similar payoffs, 10,000 here, 10,000 there. If you have two debts that have similar payoffs. Why similar payoffs? Because we're trying to compare apples to apples. We're trying to have an apples to apples comparison. Even the folks over at that snowball group, they will tell you that if you have two debts with similar payoffs, you need to attack the higher APR ones. Even the folks over at that snowball group will tell you that. Since a lot of times they have some factions of Velocity Banking Group that wants to follow that snowball group. Well, why they didn't follow that advice? Even the folks over at that snowball group know that. And they mentioned that when I was doing my research on that snowball, they mentioned that on one of the books. These folks, they have like thousands of editions. This time he was on, I think he was on page 112. Page 112. Revised. Third edition. From the Total Money Makeover. Page 112, revised third edition. So I don't know how many different editions they have. Because you typically have new editions when you want to make corrections or when you want to make updates. So I don't know how many corrections or updates the folks over at that snowball group gonna make. And when I was doing my research, I stopped at third editions. So I don't know how many different editions that they have. Because these folks, all they want to do is writing books and selling books. Okay. Even though they have an inferior debt repayment method, we are talking about that snowball group. But they're selling books though. Why? Because these folks, they are a master marketer. Okay, they know how to market even trash. Because in America, you don't have to have something good. Okay. To sell, you could even sell something bad. Because these folks, the way they pay off debt is to attack the lowest balance. That is one of the silliest things I've ever heard. When you have all different moving parts, because paying off debt is very complex. Okay, there are ways to just attack the lowest balance. No, it's not gonna get the job done. Okay. So again, even that snowball will tell the folks of our Velocity Banking Group that when you have two accounts with similar payoffs, you need to pick the one with a higher APR. You need to attack the one with a higher APR first. Similar payoffs, 10s and 10s. Okay. Now, since we're on the subject with that snowball, let me put it over here. These folks, just like Velocity Banking Group, they don't have a cohesive message either. Why am I bringing that up? That snowball group wants you to attack the lowest balance. Okay. And a lot of people have credit cards. If you have these guys, well, can I consolidate my credit card into one payment with either a personal loan or whatever other account? They'll tell you, no, we don't want you to consolidate your credit cards, because all you're doing, you're just moving your balance around. That's why they will say, so no consolidations. When I was doing my research on those guys, no consolidation with regards to credit card. But if you ask these folks, hey, but I have a bunch of student loans, okay? They will tell you that, oh, for student loan, you could refinance. So for student loans, you could refinance your student loans. But we'll tell you you could refinance your student loan so long as you could get a lower interest rate. For student loan, you could refinance, but he has to be onto a lower interest rate, and it cannot be variable. The interest rate has to be fixed. So you can only refinance into a fixed interest rate. So variable is a no-go. Okay? Folks, is any refinance? In the case where you have 2, 3, 4, 5 different students, well, wherever how many, let's just say 2, 3. When you refi, you're gonna move however how many student loans that you have into one single account. Isn't that a form of consolidation? I could move all my student loan into one account via refinance. So for a student loan, they're going to allow some type of transfer or some type of consolidations. For student loan, they'll allow some form of transfer, some form of consolidation. That's what happens when you refine your student loans. But these folks, if you ask them about consolidation on a credit card, they'll say, no, 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 no. Don't do it for credit cards. Because all you're doing is moving your money from one account to another. Okay? What are you doing on a student loan? Aren't you moving your balances from one account to another? And these are the folks that people are referring to as financial gurus. You know, this group, Debt Snowball Group and Velocity Banking Group, these two groups, a lot of times, they don't even have a cohesive message, man. No cohesive message. A lot of times they just don't know what they are talking about. Okay? Because most of you guys are kind of ignorant when it comes to this personal finance thing. That's why when somebody is spilling out trash, you won't even know. For credit card, you cannot consolidate. But for student loan, oh yeah, you could refile your student loans. Isn't that a form of consolidation? Isn't that a form of transfer? But under main debt repayment method, you cannot transfer. All they're using is just cash flow. But for student loan, they could transfer. For student loan, they could consolidate. And again, refinance your student loan or your different student loan into one account. That is a form of consolidation. Isn't it not? That is a form of transfer, isn't it not? That's what happens when you just rush in and start putting out and start rolling out debt repayment method. Okay? These folks, man, they need to stop and think. Okay? Before they start talking about stuff. Because for us over at Ambroise Method, America, we are the shepherd, shepherding the flock. And who are the flocks? The regular Janes, the regular Joes. Okay? You guys are too busy or too ignorant to understand this personal finance thing. That is why anybody could sell you crap. Paying off debt in the case of Debt Snowball is to send payment to the low, send cash flow to the lowest balance. Every other account receive minimum payment. What is that gonna do, man? That's not how you pay off debt at all. In the case of Velocity Banking Group, is to dump all your income into an account that offers greater liquidity in the case of an HELOC. These folks, they're just blindly doing things. They never run the numbers at all to see if this thing even makes sense. And these guys, if I didn't, I guess they're talking with both sides of their mouths. The folks over at Debt Snowball Group. You cannot consolidate in the case of credit card, but you could consolidate when it comes to student loan. If the student loan had a variable rate, well, try to move it to a fixed rate. Well, a credit card has variable rate. Most credit cards have variable interest rate. Student loans have variable interest rate. Some student loans. The folks over at that snowball group, they're all saying if the student loan has variable interest rate and you're trying to refi, go ahead and refi and change the variable rate and try to see if you could get a fixed rate instead. Credit card has variable rate. Can't you get the credit card to a fixed rate instead? If that's your model, if that's your thing. Some student loans have variable rate, just like credit card, America. But for student loan, you could refi into fixed. Can't you do the same for a credit card? Can't you consolidate your credit card into a fixed rate? These folks, they're from the generation where variable rate is bad. Talking about the folks over at that snowball group. Variable equal bad. Fixed rate equals good. It's easy to know how knowledgeable a group is when they start talking about this nonsense. Variable rate is bad, fixed rate is good. That is why if your student loan, they are variable rates, you have to move them over to fixed rate. And again, for these folks, variable is bad, fixed rates are good. Now, for some of you guys, some of you might be better off in a fixed rate. Okay? But this thing about variable rate is bad, fixed rate is good. The folks over at that snowball group, in what context, dude? And again, folks, over at Ambroise Method, we are the shepherd in the flock. Meanwhile, we have people living paycheck to paycheck, man. Got the folks over at that snowball group telling you to attack the lowest balance. A lot of times the lowest balance is on a low APR. Okay. Remember, low and low is no good. Okay. So in essence, these folks are going to force you to pay more interest than you have to. Because you're attacking the lowest balance, that's on a low APR. Okay. Meanwhile, you live in paycheck to paycheck. So since you attack the lowest balance, that might be on a low APR, you're helping the big bank, the big creditors, because you're making those big bank, those big creditors are going to make more interest on you. They're going to earn more interest on you. So in essence, these folks indirectly, the folks of our debt snowball group, inadvertently, they are becoming agent of the big bank, the big creditors, agents of big banks. Because they're helping big banks out by forcing you to attack the lowest balance. Inadvertently, agent of the big bank, the big creditors. So they are hurting the American people by forcing you to pay more interest. Inadvertently. And again, I'm not saying they do that on purpose, okay? But their plan will force somebody, depends on the example, to be paying more interest for no reason. Again, folks, no cohesive message with these two groups. You cannot consolidate credit cards, but credit cards have variable rates. Most credit cards have variable rates. But you could refi your student loan. Some student loans have variable rates. Well, what's the difference? Why am I allowed to consolidate here, but I'm not allowed to consolidate there? Are they saying stuff erroneously? Or they didn't properly think things through before they start talking? Or they just flat out don't know what they're doing or what they're talking about? Variable rate is bad. Fixed rate is good. Well, you can't blame them. These folks, they're from a generation where at one point the inflation was going rampant and they got burnt in the past. So that's probably why they still have that mindset that variable rate is bad, fixed rate is good. So I guess they developed some form of fear because they got burnt in the past. I think that happened sometimes in the 80s where inflation went so bad to where the lenders or the creditors start cranking up all the variable interest rate. Because remember, it's a variable interest rate, so it's going to fluctuate. Okay? And if I remember right, that was in the 80s. I was just a little kid at that time. Anyways, America, I'll give you about 5-10 seconds to take a look at what's on the board, and then we're going to continue with the exercise. All right, America. Now, that was the result for without compounding. And before I forget, let me put the results for with compounding, because remember, most lenders, most creditors use an average daily balance, including new transaction with compounding. On the board we have without compounding, and again, I did not want to put my formula, my proprietary Excel formula for with compounding on the board because I don't want my competitors to start stealing it, or to start copying it. So let me give you real quick the results for with compounding. So this one was without. So we're going to give you the results for, and put it down here, down below. This is without compounding, and it's going to be with compounding. Okay. So this was without, and this right here going to be with. Okay. Okay. Now let me open up my proprietary calculator. I'm in a proprietary Excel formula for average daily balance, including new transactions with compounding. So I could give you the results real quick. Let's take off the HELOC first, 8.25%. 10,000. These numbers are so small, I'm working on the phone, so bear with me. 6805. So the original monthly interest charge would have been 6805. Oh, I'm sorry. I'm right here for the HELOC. 6805. And if we have 9,000 going in on day one, so minus 9,000. And we have 7,000 going on day 26. 7,000. So now we are at 1473. 1473. Okay. So now let's take off the one for the credit card. The credit card was at 29.99. So let's change that from 8.25 to 29.99%. So I am at 5396. 5396. And let's do the original monthly. So let's take out 24966. 24936. 24966. 24966. Okay. Now let's figure out the original rate over here is 29.99%. So if our new monthly interest charge is 53.96, so let's do this one first. 249.66 minus 53.96. We are at 195.70. Okay. Over here, 29.99 minus 6.41. Let's find out how much 53.96 represents. $6.48. 6.48%. That's what 53.96 represents. So 29.99 minus 6.48. We are at 23.51. Okay. Okay, so over here, the original rate was 8.25. So if we are 1473, let's see what the effective rate is. The effective rate is 1.77. 1.77%. That's how much $14.73 represents. So 8.25 minus 1.77, so we have 6.48. Okay. 1, 2, 3, 1, 2, 3. Okay, here 6805 minus 1473, 5332. Okay. All right. Okay. All right, America. So that was the results for with compounding. Okay. The original interest rate 8.25 on the HELOC. We arrive at the monthly interest charge that is smaller, that is larger. I'm sorry, 1473. 1473 is bigger than 1469. Why? Because when you're using compounding, that's like interest on top of interest. So this one balloon out from 1469 to 1473. Okay, not by much. What, another 4 cents? Okay, so 1473 represents 1.77%. Okay, 6805 it would have been if you didn't have any movement, minus the new monthly interest charge for having income coming in and expenses going out. So we had 1473, 6805 plus 1473. So they are saving 5332. Over here on a with compounding, average daily balance including new transaction with compounding. Okay, so $29.99 was the original APR on a credit card. We arrive at an effective rate of 6.48. Again, 10,000 times 6.48% divided by 12. 53.96 or 54 bucks. Okay. 29.99. We arrive at an effective rate of 6.48, which means we're saving 23.51. The original monthly interest charge would have been 249.66. Our new monthly interest charge 53.96, so savings of 195.70. Okay. So whether you're using it without compounding or with compounding, okay, the results, you arrive at similar results when you're comparing an HELOC versus a credit card. And again, difference in percentage savings, 6.48. 6.48 is smaller than 5.51%. Okay. Difference in monthly interest cost savings, $53.32, $53.32. $53.32 is smaller than $195.70. Okay. So no matter which formula that the lender uses with regards to whether it's with compounding or without compounding, the HELOC still loses if you're comparing it with a credit card. So as far as the debt weapon, debt tool, line, credit line, debt destroyer, it should not be the HELOC. Okay? Because the HELOC gonna force you, America, to go backwards. Alright? So don't you ever do any silly things like that, dumping all your income onto an HELOC when you have another line on the board where the interest rate is considerably higher than the interest rate on the HELOC. For this one, the interest rate doesn't even have to be considerably higher. It just has to be a little higher than the HELOC. Okay? Alright, America, I'll give you about 5-10 seconds to take a look at what's on the board, and then we're going to continue with the exercise. America. Now, let me erase some stuff on the board. Let me go over here instead. All right, America. So now, based on the results, so we know that the HELOC will be a poor performing debt tool, or poor performing alternative account. Same thing would have applied if you was a PLOC. The PLOC, America, personal line of credit, would have been, if everything were the same, a poor performing debt weapon or debt tool. Same thing would have applied if you was a BLOC, business line of credit. Okay? A poor performing debt tool. Same thing would have applied if you was an all-in-one loan. Poor performing debt weapon, a poor performing debt tool. Because what? All-in-one loan, the interest rate, just like the interest rate on the HELOC, is usually smaller than the interest rate on a credit card. Okay. So when you're comparing two lines, your movements of income and movement of expenses should happen first in a higher APR one. Okay. Same thing would have applied if you was a first lien HELOC. Sometimes these two products are the same, but they could be different products, okay? All-in-one loan, first lien HELOC, okay? Whether he has a one-way sweep, because these are, a lot of times they are different companies, they might have a slight variation between those two, okay? Sometimes they're the same, because here over, when we're doing our lesson, we're using those two terminology interchangeably, but they could be different product, okay? Could be the same, could be different product. First in HELOC, one-way sweep. Poor performing debt tool compared to a credit card that has a higher APR. First in HELOC, two-way sweep. Poor performing debt tool, okay, compared to a credit card. Okay. And again, the interest rate on these items are generally typically smaller or lower than the interest rate on a credit card. Okay. And I'm gonna later on make a cheat sheet and put that on my list before I forget. For the folks of our Velocity Banking Group, so it could help them out a little bit. Because some of them meant well, they are not bad people. They are just misinformed. First in HELOC one-way sweep, first in HELOC two-way sweep. Okay. Same thing would have applied if he was a IBC. Infinite banking concept coupled with an all-in-one loan. Poor performing debt tool. When we have a credit card or another line with higher APR on the board. Okay. Maybe I'll do another lesson on this new shiny object or this new product called infinite banking. Because I've seen some of the folks now over at Velocity Banking, you know, they want to use this so-called infinite banking concept in conjunction with an all-in-one loan. And again, this plan would have been a poor performing debt tool. Why? We already proved to you guys, well, you know, on an all-in-one loan, let's not even talking about the life insurance part of it for now. Well, all-in-one loan, these loans generally have a lower APR compared to, say, a credit card, generally, okay? So if you're gonna couple this infinite banking concept with an all-in-one loan, so let's assume this infinite banking concept was good. Let's just assume it was good, okay? Well, this all-in-one loan is not, okay? Because a credit card will have similar results. So, you know, just like we had with the HELOC. So a credit card would be a better debt tool. So you would have this infinite banking concept with a bad debt tool. Or with a debt tool that's not as good. Okay? So that's why it would have been a poor performing debt tool when you couple that one with an all-in-one loan. Because an all-in-one loan wouldn't be able to get the job done right compared to a credit card. And again, the numbers don't lie. Okay? And for all-in-one loan, the interest rate are typically lower than the interest rate on a credit card. Just like the HELOC, the interest rate is lower than, say, the interest rate on a credit card. Okay? Now, together, not good. Okay? Well, separately, this all-in-one loan would not work. Okay? This infinite banking concept, let me spend a few seconds on it, because I know not everybody has the same level of knowledge, so I'm not going to go too deep into this infinite banking concept. Okay? This idea, America, that you need to go get a life insurance policy to pay off debt. Okay? Just like you need to go out there get an HELOC to pay off debt. Just like you need to go out there get a PLOC, personal line of credit, to pay off debt. No. Okay? In some applications, it might be advisable, just like I mentioned from past lessons, to go out there get an HELOC to pay off debt. To go out there get a PLOC to pay off debt. To go out there get a life insurance policy to pay off debt. In some applications. Okay? I'm not saying they don't have no use. Okay? But for most of you guys, the regular Janes, regular Joes, yeah, don't even bother with this nonsense. Okay? And again, the product by itself is not a bad product. Okay? But when you're trying to pay off debt, you need to go out there and acquire new product or new shiny objects to pay off debt. No. Because a lot of times you could achieve the same thing with a credit card in some examples. Okay? In some examples, you could achieve better results with a credit card. I'm talking about the consolidation part, the transfer part. Okay? Yeah. And the way I see some of those guys over at Infinite Banking Group trying to explain it, these salesmen, okay, you know, they're kind of disguising themselves as trying to help you to pay off debt. But in reality, really, you know, they just want to earn a commission on you, you know, by forcing you or by telling you to go ahead and go and get a life insurance policy. Okay? So be mindful of that. These people are salesmen. Okay? Some of them are good salesmen. Some of them are bad. Okay? Some of them, they know how to sell that product. Some of them, they don't quite know what they're talking about. Okay? Because I watched some videos on these folks over at Infinite Banking Concept. From this so-called Infinite Banking Concept. Okay? They refer to it as be your own bank. BYOB sometimes. Be your own bank. Folks, it's an insurance product. How you gonna be your own bank with an insurance product? Okay, that's just their little ploy, their little way of trying to make this thing sounds good, so they could sell it to you. Okay, because remember who you're going against. You're going against a lot of times a big insurance company. So you meant to tell me you are smarter than the insurance company? You're not being your own bank. You're not gonna beat anybody. You're just gonna hurt yourself trying to get a life insurance policy to help you facilitate your fight against debt. So most of you guys stay away from it. Okay? Most of you guys. And the way I see some of them trying to structure that product, okay, they like to talk about a 60-40 structure. Some of them will talk about a 70-30 structure. And you got some that might talk about a 90-10 structure. Okay? And the way they refer to it is that the 40 portion, they call it a base. And the 60 portion is the paid up addition. They refer to it as PUA. And remember, these things are dividend paying whole life insurance. Obviously, there's a death benefit and there's a cash value portion. Okay, so the way that these folks like to explain it, they're structured in a way to where most of your money goes towards the general account or this so-called paid up addition, or the cash value portion, to where you could kind of, for lack of a better term, use it and you reuse it. And that's how you could kind of use it in a way to help you facilitate your fight against debt. So basically, you borrowing your own money, okay, and to pay off debt. And again, we're not going to get too much into it, okay, because for the regular Janes or regular Joes, again, stay away from that product. Infinite banking or be your own bank or infinite banking concept coupled with an all-in-one loan. Infinite banking concept working in conjunction with an all-in-one loan. Stay away from it, okay? Yeah. Because most of you guys, are ignorant when it comes to simple things like figuring out interest cost, and now you're gonna try to dab into, trying to go into life insurance policy or whole life insurance policy. For most of you guys, don't even bother with it at all, okay? Don't allow these salesmen to force you to go get a life insurance policy to pay off debt, America, okay? Stay away from it, all right? But the product itself is not a bad product. In some applications, some applications, it might be advisable to do some funny things like that. Okay, but you could go out there and get something better to help you accomplish the same thing. Okay, and you definitely do not want to couple it with an all-in-one loan. Okay, because the all-in-one loan, just like we proved earlier, may not be the best approach. Okay, depends what other account that we have on the board. All right, America. That is to briefly touch on this so-called be your own bank or infinite banking concept coupled with all-in-one loan. Okay, again, and all the HELOC, home equity line of credit, will be a poor performing alternative account or poor performing debt tool. A PLOC, poor performing debt tool. BLOC, poor performing debt tool. All-in-one loan, poor performing debt tool. First in HELOC one-way sweep, the old ones, poor performing debt tool. First in HELOC with two-way sweep, poor performing debt tool. Infinite banking concept, life insurance by itself, poor performing debt tool. Infinite banking concept coupled with all-in-one loan or working in conjunction with an all-in-one loan, poor performing debt tool. Okay, when we have other accounts on the board where the APR is considerably higher than the APR on these accounts. Okay? For this infinite banking coupled with all-in-one loan, the APR on the all-in-one loan. Okay? Alright, folks? So for most of you, the regular Janes, the regular Joes, again, stay away from these products when you have other accounts on the board with considerably higher APR. Okay, folks? All right, America, I'll give you about 5-10 seconds to take a look at what's on the board, and then we're going to continue with the exercise. And I didn't even touch on this so-called MEC seven-year test rules. Okay, because America, a lot of times the folks who are selling this so-called infinite banking concept, this life insurance, okay, I've watched a few videos. Okay, some of these guys, you know, some of them, they don't quite know what they're doing. Okay, so there might be a small chance to where that regular insurance might get reclassified as a MEC. Okay, so that's gonna create some problem for you guys. Okay, because you know, I don't trust these folks, because some of those folks I see talking about them a couple months ago, a couple years ago, they were talking about velocity banking, and now all of a sudden now they are a life insurance agent. Okay, so some of these folks obviously do not know what they're doing. Okay, so there's a small chance to where your regular life insurance policy might get reclassified since they don't fully know what they're doing. Okay, to where you're not gonna meet the so-called MEC rule. Okay. As the modified endowment contract. All right, America. So be careful with these people. Okay. Yeah, I've seen one of them, one kid. Seen a lady too talking about this stuff. Okay. A few months ago, these folks, they were trying to get you to become their client, or they were teaching about velocity banking. And within that short time frame, okay, now they are insurance agent. So, okay. So these folks, a lot of them don't have the experience yet, okay, to be selling you life insurance to begin with. Okay. Unless they're just the middleman, you know, which might make a difference because they have somebody above them and they are just the middleman just to bring the business over. Okay. So, you know, that, you know, I can't really go against them too much because they're trying to earn a living. Okay. But understand that who you are dealing with. Okay. When it comes to life insurance. Okay. You could go separately out there and acquire life insurance if that's what you want. Okay. You don't have to do it, you know, in a way to help you facilitate your fight against debt. If it's term insurance that you want, go out there and get term insurance. If it's whole life insurance that you want, okay, or universal life, whatever type life insurance that you want, go out there separately and get that insurance. Okay. Yeah. Not trying to do it coupled with an all-in-one loan. Okay, folks. All right. And again, these folks, they are not knowledgeable enough. Okay, but I don't know if they're trying to structure those policies themselves or if they have somebody else structuring those policies for them. Okay. So in any event, okay, stay away from it. Okay. Because let's say that they make a mistake and your insurance got reclassified, okay, because they didn't quite know what they're doing, and then now you ended up in a bigger mess, okay, than where you started with. So stay away from it. All right, America. Now, the folks over at Velocity Banking Group, remember earlier from a past case study, I told you guys that they started out with a credit card, and that credit card, a few months later, they tell the folks to use a HELOC, to use a PLOC. A few months later, they tell the folks to use life insurance to pay off debt. A few years later, all-in-one loan coming to the market. Okay, so, and again, they're chasing any and every new product, any and every shiny object that come into the market. Okay, because they were not doing their due diligence. Okay, so they went from a credit card, and at some point down the road, it was an HELOC. Okay, so these folks, they are moving away from something better to something worse. Okay, a lot of times, because again, the credit card generally have a higher APR than an HELOC. And it prove to you guys, when you have to have your movements of income and movement of expenses, that movement should happen inside the higher APR account. And again, the numbers don't lie. Okay? Greater savings here, greater savings here. Okay? So now, to help on my America, let's create a little cheat sheet form. So we're going to compare a line versus another line. Okay? So we have a line with a low APR. We have another line with a high APR. Okay? Line with low APR, that would be the HELOC. And again, 8.25 is lower than 29.99. Line with the high APR, that would be the credit card. Okay? America, let's create a little cheat sheet for them. Let's try to help them out. Okay? Remember, folks, when you're paying off debt, you're going to come across three main elements, three main assignments, three main jobs. And these elements, these assignments, these jobs are transfer. So let me use their terminology. They refer to it as chunking. So chunk. Alternative account. They refer to it as debt weapon or debt tool, or line or credit line or debt destroyer. Okay. Then we have cash flow. These folks, they do not separate the cash flow, but I like to separate the cash flow. Because for them, all the income comes into that account, and all income includes cash flow. But I like to talk about the cash flow separately. For us, that's our TAC. T for transfer, A for alternative account, and C for cash flow. Okay. We're doing a line versus another line. Put it a little bigger here. So, because these folks, they are not bad people, America, so we're trying to help them out a little bit. Okay, so we're going to create a little cheat sheet for them. Okay. The low APR line is the HELOC. HELOC, 8.25%. The higher APR one is the credit card. The credit card 29.99%. Okay. With regards to chunking or sending a large payment to other accounts, okay, you wanna chunk out of the HELOC. So you're gonna make a chunk payment from the HELOC going to the other account. Okay, so now the HELOC wins. Okay. In essence, you are relocating balance from higher APR and you're trying to dump it onto the lower APR. So for that reason, the balance on the HELOC gonna go up and the balance on the credit card gonna go down. The balance on the HELOC gonna go up by the amount of the chunk payment, and the balance on the credit card gonna go down by the amount of the chunk payment. Okay, so the HELOC wins. Okay, they are not invalid. You could still use them. Okay, but know that we have different jobs. For which jobs are you going to use them for? Okay, HELOC wins over here with regards to the chunk payment, because you're going to send the chunk payment out of the HELOC. As far as a debt weapon or debt tool or line or credit line or debt destroyer, that account needs to be the credit card. Okay. All right, folks. And the numbers don't lie. 6.9% savings, 6.48% savings, 23.58% savings, 23.51% savings, whether you're doing without compounding or with compounding. The first one is for without. Okay. Okay. Savings, $53.12 without compounding, $53.32 with compounding. Savings, $193.08, $195.70. Okay? And again, we're having greater savings over here. Okay? So that's why the credit card needs to be your debt tool. Now, in a situation where the credit card cannot cover everything, okay, then whatever portion that the credit card could not cover, then you could call upon the HELOC at that time. Okay. So in this case, you're gonna be using two separate alternative accounts. In an example where the credit card could not cover everything and the credit card, so the credit card was limited, in that case you call for the HELOC. Okay? But the credit card is first. So it's after you send all the funds into the credit card first. Then you could start thinking about the HELOC. Okay? And as far as cash flow, okay? So who gets to marry this virtuous woman named Cash Flow? Okay? Well, cash flow is better served, America, in the account that has the higher APR. So that would be the credit card. Okay? So that's a little cheat sheet that I created for them, okay, to help these folks out a little bit. Okay? For chunk payment, we here. We there, we here. Okay, folks? That's the difference. Okay? So America, do not go blindly and start dumping all your paycheck onto the HELOC. And again, remember the question that was posed to me, that financial coach posed to me was, James, can you prove to us that a credit card is a better debt tool than an HELOC? Okay? So that is the cheat sheet, America. Okay? So in this case, we're going to be using an example like this, where when the credit card cannot cover everything, we use two separate alternative accounts. Okay, because head to head, the credit card wins. Head to head, the credit card wins. Apples to apples comparison, the credit card wins. So the credit card will be listed first. Okay. Cash flow, 9,000 minus 7,000. 2,000 cash flow, sort of. 9,000 minus 7, including, so 2,000 cash flow. So cash flow is better served in the credit card, to go into the credit card. All right, folks, that's the cheat sheet. Okay, to help the folks over at that Snowball Velocity Banking Group a little bit. Okay, because these folks, again, so far they haven't proven to have the capacity to properly analyze this thing. Okay, so because they are not bad people, I'm trying to help them out every chance that I get. I'm not a YouTuber yet, so every chance that I get, when I have an opportunity to come and make a video online on YouTube, then I was trying to help them out. Okay. Reason say, like I mentioned from past lessons, I said I'm not a YouTuber yet because I only put out a video once every week, once every month, once every 3 months, once every 6 months. Depends how busy I get. Okay. All right, America. Don't give me money, don't give me fame. After God, give me numbers, baby. This is it, man. This is when you know how to properly use alternative account, or so-called debt weapon, or debt tool, or line, or credit line, or debt destroyer for them. Okay. This is good stuff, America. Allow me to blow a kiss to my Father, our Lord and Savior Jesus Christ. I'm a baby Christian, so I hope to love you the same way you love me. Spirit of Father, thank you. All right, America, I'll give you about 5-10 seconds to take a look at what's on the board, and then we're going to continue with the exercise. All right, America. So the folks over at Velocity Banking Group, they went from a better debt tool to a worse debt tool, okay? But because they are ignorant or not knowing how to properly run numbers, they thought the worst debt tool was a better debt tool than the credit card. Why? Because the HELOC offered greater liquidity. You could pay everything through a HELOC. These folks, they are misinformed, okay? Going from something better to something worse. Okay. This is why we refer to America as the equivalent of madness. Can't go from something better to something worse. Okay. But they don't know how to run numbers. Okay. They don't know how to properly analyze things. So that's why they're doing this nonsense, asking you to dump all your income into an 8.25% HELOC when we have considerably higher APR account on the board, like this credit card, 29.99%. Okay. So, the folks over at Velocity Banking Group, for all these flaws, all the mistakes that they keep committing, okay, so they would never ever be able to compete with us. Okay, their plans got too many flaws, too many mistakes, man. Okay, can't even pick the right debt weapon. And you got the folks over at that Snowball Group. Yeah. They're not any better. Okay. These folks, they don't have a cohesive message. At one point, they'll tell you to attack the lowest balance. And at another time, when it comes to student loan, they're going to tell you, oh, it's the lower interest rate that matters now. Lowest balance, when they want to attack accounts, lowest interest rate. So which means they want you to attack the higher interest rate because they want you to refinance into lower interest rate. Okay. All of a sudden now, these folks, they are concerned about interest rate. The folks over at Debt Snowball Group. I thought they were not concerned about interest rate at all. I thought they were only concerned about lowest balance. How come now they're telling folks to go refi into lowest interest rate with regards to a student loan? So I guess just like Velocity Banking Group, I guess they are evolving. They can seem to make up their minds, okay? Not consistent at all. No cohesive message, just like Velocity Banking Group. When you're paying off debt, hey, I want you to attack the lowest balance. But with regards to a student loan, hey, you need to refine to the lowest interest rate. Lowest balance, lowest interest rate. It seems like they are talking with both sides of their mouths, the folks of our Debt Snowball Group. Okay? But it takes somebody that master this thing called paying off debt to be able to point out this thing to you guys. Yeah. So they are quietly changing their tunes a little bit, the folks of our Debt Snowball Group. Quietly. Okay? But they think nobody's paying attention. America, over at Ambroise Method, we are the shepherd, shepherding the flock. Who are the flocks? Regular Janes, regular Joes. Okay. Now, as you could see, America, we are a superior debt repayment method compared to Debt Snowball Group, compared to Debt Avalanche Group, compared to Velocity Banking Group. Okay. Why? Let me break it down even further. Folks, when you're paying up debt, you're going to come across three main elements, three main assignments, three main jobs. And these elements, these assignments, these jobs are transfer, alternative account, and cash flow. Okay. For Debt Snowball, okay, the way they go about their regular business, they only use the C for cash flow. Again, these folks, they want you to send all your paycheck. They want you to send whatever extra money you have left over onto the account that has the lowest balance. Okay? But remember, we generally have three separate jobs, three separate assignments, three separate elements when you're paying off debt. Debt Snowball Group only taking advantage of one out of these three items. Okay. Folks, that is 1 out of 3, or 33%. Just like I told you guys from the last lesson. Okay? Because they're not turning in all of the assignment. They're only turning in C for cash flow. Okay? A lot of times they're not taking advantage of transfer. They're definitely not taking advantage of the alternative account. Again, that's our tack on our method. T for transfer, A for alternative account, C for cash flow. Okay? 1 out of 3, they're only doing 1 out of these 3 items, 33%. Folks, last time I was in school, 33% was a failing grade. Okay? For that avalanche, just like that snowball, all these folks wants to do is to send whatever money left over or cash flow to the highest APR account. So they're only taking advantage of cash flow. Again, 1 out of 3. That's 33%. Folks, last time I was in school, 33% was a failing grade. Finally, we have Velocity Banking Group. These folks, let me use their terminology, they chunk. They have a debt weapon. And we like to talk about cash flow separately. Whatever account that they use as the debt weapon, they're going to dump. That account going to keep the cash flow. So if you give them an example like this, HELOC and a credit card, you'll be HELOC everywhere. It'll be HELOC here. For chunking, HELOC as a debt weapon. HELOCs to keep cash flow because they're going to dump all the income onto the HELOC. And all income includes cash flow, so they're going to keep cash flow inside that account for 3 months, 6 months, 9 months, 1 year. Okay. Folks, this account we proved to you earlier was the one debt weapon, let alone keeping the cash flow inside that account for 3 months, 6 months, 9 months, 1 year. And again, folks, you wait, you lose. Okay, so don't keep that cash flow inside an 8.25% account when you have a 29.99% account on the board. Okay, all right. For us over at Ambroise Method, okay, for this example, I put in this example. And we put Ambroise Method here overall. For this example, chunking, of course, we're going to chunk out of the HELOC when we have if we were at an opportunity. Okay, because the HELOC had a lower APR account. In essence, we're going to be relocating balance from higher APR account and dump it onto the lower APR account when we have an opportunity to do transfer from the HELOC. Okay. For that weapon, I told you guys earlier, it's going to be the credit card first because the credit card offers greater results in terms of reducing interest cost or in terms of interest savings. And again, the numbers don't lie. Okay. Regardless what formula you're using, whether you're using an average daily balance including new transaction without compounding or average daily balance including new transaction with compounding. Okay, so the credit card in this case will be first. Now, we're going to call upon the HELOC after the credit card is used up. Okay? So for bills that cannot be paid with a credit card, that's when we're going to call for the HELOC. And again, head to head, the credit card wins. So the credit card has priority. Okay? And as far as cash flow, this virtuous woman named Cash Flow, okay, who gets to marry this virtuous woman? Well, the credit card, because the credit card has the higher APR. Cash flow is better served to go into the higher APR account. Okay? You see? HELOC, HELOC. Same thing here. HELOC for them, credit card for us. And depends on the example, we might call upon the HELOC last. Okay? HELOC here, credit card there. Okay? our process is very different than their process. Okay. Why? Because we've already mastered this thing called paying off debt. Okay. Overall, chunking for transfer, we have at least 7 different ways on how we execute balance transfer. Okay. This was for this example, but overall, we have 7 different ways on how we execute balance transfer. As far as that weapon, sometimes we use 1, 2, 3. In this example, we'll be using 2. 1 and 2. On the lesson I haven't covered, I'm going to be using 3 alternative accounts simultaneously. That's having movements of income and movement of expenses in 3 separate accounts at the same time. Well, let me use your terminology. That's having income coming in and expenses going out, not just in 1 account, not just in 2 accounts, but in 3 separate accounts at the same time. That's the lesson I haven't covered. Okay? And as far as cash flow will go to the higher APR account, so that'll be the credit card. Okay, folks? So, not only we're doing everything better than they are, we're having greater results than they are. Okay? So for chunking, in this particular example, we have same thing here. For that weapon, they're using 1 debt weapon. We're going to be using 2 debt weapon. If it belongs to them, we're going to be using the credit card. That one has priority because this one achieved greater results. Then we're going to use the HELOC. So they're using 1, we're using 2. And as far as cash flow, they're sending cash flow to the 1 account for 3 months, 6 months, 9 months, 1 year. We're sending cash flow to the proper account, which is the credit card, because we achieve greater results in terms of reducing interest costs or in terms of interest savings inside the credit card. Okay? So which debt repayment method you think, America, gonna go past the finish line first? We're doing everything better than these folks. Those rookies over at Velocity Banking Group trying to challenge me on YouTube, when these folks don't even know how to properly calculate interest cost. They can't even properly read the amortization schedule, and they're trying to go against me. Well, against us over at Ambroise Method. These folks, man, so far they haven't proven to be knowledgeable enough to challenge us. No. Your plan's got too many flaws. Not only that, some of these folks teaching about velocity banking, again, the background is kind of questionable. Okay. Now, this is the results. Okay? So, it's an open challenge. I want the folks over at that snowball group to settle their differences with the folks over at that avalanche group. Settle their differences with the folks over at velocity banking group. I want these 3 groups to settle their differences and create a force, America. Okay? Now it's going to be 3 versus 1. 1, 2, 3. These 3 groups versus my method, Ambroise Method. Because individually, each one got too many flaws, too many weaknesses. So maybe if they combine forces, maybe they might be able to do better against my method. Okay? America, even if they combine forces, because I want these folks to have a meeting So they do. I remember that one show. I think it was. What was that one show with the fake dragon? The dragon was burning people up. The Lannisters. where, where that one young kid said, "You need to bend the knee." So that snowball group, you need to bend the knee. Bow to your new king, Ambroise Method. That avalanche, you need to bend the knee. Bow to your new king, Ambroise Method. Velocity banking group, you need to bend the knee. Bow to your new king, Ambroise Method. Alright, America, I'm just having fun with these guys. Alright, America, I'll give you about 5-10 seconds to take a look at what's on the board. And then we're going to continue with the exercise. Alright, America. Again, my name is James Ambroise. I am the author, creator of Ambroise Method 1.0 and Ambroise Method 2.0. Ambroise Method is a revolutionary debt repayment method that offers greater results in terms of reducing interest cost compared to debt snowball, debt avalanche, velocity banking. Thank you, Jesus. Until next time, America. Good morning.